Disclaimer. This material in this presentation has been prepared by ADCM, LLC DBA Willow, and is general background information about Willow's activities, current as at the date of this presentation. This information is given in summary form and does not purport to be complete. Information in this presentation should not be considered as advice, or recommendation to investors or potential investors, in relation to holding, purchasing or selling securities or other financial products, or instruments. Neither the information nor any opinion expressed herein constitutes an offer or a solicitation of an offer to buy or sell securities. Before acting on any information, you should seek independent financial advice. All securities and financial products involve risks. While due care has been used in preparation of this presentation, the information contained herein has been obtained from sources believed to be reliable, but its accuracy and completeness cannot be guaranteed. Forecasts and hypothetical examples are subject to uncertainty and contingencies outside Willow's control. Past performance is not a reliable indication of future performance.
So welcome. As people stream in, we'll just give it a minute or so and let.
Yeah, it's going to be a bit because I think, okay, we have people streaming in now. Yeah. So I think once we go into sharing slides, you won't see me because I am traveling today, as you can see, but Paul and I knew it was important to do a little update, even if it's 15, 20 minutes. Our intention is to do a fuller one as we get more information, but clearly there's a lot of externalities, a lot of events that are taking place that obviously we're taking notice of. For those of you who work with us, for those of you who have your money managed by us, you know that we have been conservative. We continue to be conservative. We have known that something's not right in the system, and therefore we've been moving ahead of it, and you know that. So bear with us. We're doing the best we can with the information that we do have. One of the things that I will say is, of course, this is very similar to what we saw during the financial crisis, where banks unexpectedly or expectedly, I don't know. I think Paul and I have had our concerns about the financials for quite a while. We see a couple failures that have taken place. They are smaller tier banks. We do believe that the larger tier banks are decently capitalized, but that doesn't mean that there can't be any form of contagion here. One of the things that we do want you to know is that as most of you know, we've been a little bit critical of the Fed moving too fast. And we can get into that a little bit when we get into the slides, but we do hope they are due to meet next week. We hope that they stop raising rates. I don't know if they will or won't. If they don't, as I think I've said in a previous Zoom call, Paul, probably, if you remember, if they don't stop, we have to wonder if this is an intentional move on their part to harm things. I hate to say this, but I said this before. I will say it again. It is reckless, the rate by which they moved rates. It's not that I don't believe in rates moving. It's just the rate by which they did it left us a little bit in this situation. And you'll see some charts that show that we've been drunken sailors when it comes to spending money. So let's get right into the charts, Paul, if you would.
Sure. Before we do, I just wanted to add too that the Fed has been saying for months now that they want rates to go. They need the economy to slow down as their attempt to try to lower inflation. And they've telegraphed over and over again, they're going to keep raising rates. They're going to have rates higher for longer. These are the exact words that they've said, where yes, they need unemployment to rise in order for inflation to be quelled. So it does make us question, well, is there some intention behind all this?
Yeah.
Here we go.
Okay. All right, cool. Thank you, Paul. All right, let's get right to the first one. Okay, so this chart makes me feel better. I had Paul pull this today because I wanted to see what the reserves look like at our banking institutions. Now, keep in mind, when a bank gets your money as a deposit, they take a portion of those funds, a good portion of them, and lend them out. Now, they're supposed to keep a certain amount in reserve for bad loans. So what you see here is, you can see, Paul, I can't really see to the left because I'm on this iPhone, but to the left, how many years back is that reserve?
This goes all the way back to 1960, this chart.
Okay. So, and then that spike there with the recession, that was the one in 2007. When was that?
Yeah, this where the chart starts to go up is great financial crisis. Yeah.
Okay, that's what I thought. Okay. So one of the problems after the great financial crisis is that, or the great recession, or whatever you want to call it. I don't even know. But anyway, one of the things that they did was the Fed put some stops in to require greater reserves at financial institutions. The problem is, over the last 13 years or 14, 15 years since that last incident, the reserve requirements have gone down to close to zero. Or zero, Paul, now?
Zero. Yep. The official reserve ratio that the Fed published in 2020 was 0%.
Which is ridiculous. But the good news is, fortunately, banks have continued to keep some reserve. This chart shows that they've kept some things on reserve. Now, since the Fed has been raising rates, you can see that reserve has come down. Again, a certain portion of deposits have to be kept in reserve for bad loans, but the Fed has been lowering that amount. Why have we not learned our lesson? I cannot tell you how many times this has happened over my 36-year career. But nonetheless, I had Paul pull this because I at least wanted to see where we stood. So the good news is, we do have some institutions that have a fair amount of reserves. My guess is it's probably the larger institutions, though we don't know for certain.
Right. And this would say, 3,000 billion, so $3 trillion.
Yeah, it's not a lot, you guys. I mean,
right. When you look at just how fractional reserve works, but derivatives also, you're talking many, many multiples of that is floating around out there. So, yeah.
Exactly. Okay, so let's take a look at the next slide, Paul.
Right. This is the Federal Reserve assets, right? So what the Fed holds.
Yeah. Yeah. So you can see the last recession, the very thick line over to the left, that was the financial crisis. And you can see that the Fed has been increasing their balance sheet. So what this means is that they are essentially holding more securities. Can you see that? Paul, you want to point that out and you can see they've added more debt to their balance sheet. So
right.
This is not a healthy sign, but this isn't anything we didn't know. So So right. This is representative of their share buyback, their buyback programs, their quantitative easing, their Operation Twist times 3 or 4 or what have you. And you can see they've been trying to take down their amount of assets since the beginning of last year. You can see the blue line starting to come down. Paul, did I miss something on this chart?
Nope, that's it. It just shows it's growing and growing.
Okay,
growing.
So what is this? Yeah, so what this means is that the debt that was in the private sector, essentially, a lot of it was transferred to the Fed. The Fed took on a lot of debt to keep us out of a recession. So you can see during the Corona crisis, you see that slight gray line there. You can see they sharply increased the amount that they were flooding the system with liquidity, and thus putting all the debt on their books. So this ultimately, that big sharp rise that you see is what ultimately led, we think, to the part of the reason we have the inflationary pressure we have today. Anything to add there, Paul?
Yeah, that's it. Just the balance sheet keeps rising, and when does it end?
Yeah.
Does it end? Right.
Okay.
This next chart is.
Somebody asked.
Go ahead.
You like this chart, Paul? Isn't it nice?
This is a good one, right from the IMF. Unfortunately, it's not updated for Q1 this year, but this is the latest data that they have. This shows the currency composition of foreign exchange reserves. So how many dollars or US dollars are different governments or countries holding on their books so that they can pay for trade or energy, essentially.
Yeah. And so one of the theses Paul had over those years is that I believe it will no longer become the reserve currency. The dollar here represents the dark blue lines or the dark blue squares. And you can see slowly it's coming down. And, you know, you have to understand, again, demand and supply. So if there's less demand for US dollars, like anything, like any product in the world, less demand usually means lower prices, meaning lower dollar, a lower.
Oh, I think we may have lost Alexandra there. I'll just chime in, I guess, until she pops back. She was saying lower demand for dollars, it would cause well, all kinds of issues. We talk about the dollar a lot. We've talked about it in many of our previous presentations, where this is all just one more thing over the long term that we see where the U.S. dollar reserve status is essentially being threatened. Oh, there you are, Alexandra. Did you join as a participant? Hold on, everybody. 1 second. Let me make her a...
Here, can you hear me now?
Oh, now I can, yes.
Okay, perfect. Did you carry on with this chart to explain the importance of the reserve? Good. Okay, perfect. Yeah, we had a question about what do we think of the dollar? Well, we do think longer term that the dollar will no longer be the reserve, that something will replace it. And if that's the case, then you would see the dollar value go down, which would in turn continue to raise the prices that we experience here in this country.
And there's other charts, I think, that show this data a little just over a longer time frame. And you can see for the past decade plus, this has been a trend where that reserve portion of US dollars has been shrinking and shrinking and shrinking and shrinking over time.
Yeah. Yeah.
Federal Reserve balance sheet. Here's just a, overall
another way to look at it.
Right. They've started trying to do some thing here, getting assets, letting certain bonds that they hold mature and not buying new ones.
Deleveraging. Yeah.
Markets don't like that. Or they do, short term anyway.
I mean, it's crazy that the little bit of the interest rate moves that they have made has led to where we are today. And so, okay, where do we? Oh, the yield curve. So we've been,
curve.
Yeah.
The top line here. So this just shows different years. This goes back to 2020. And so it looks at the yield curve as of today, a year ago, 2 years ago, 3 years ago. And you can see that they wear that sort of olive color, I guess, at the top, where rates have come up considerably, obviously, and the curve has also inverted, meaning the short end has gone above in terms of yield, the longer end.
Yeah. So this is typically indicative, a good discount mechanism for showing that we're going into a recession.
Yeah.
So
and just general stress, right?
Yeah. I've never seen a time when the yield curve inverted and we didn't go into a recession. I think I've said that a dozen times already, but in these calls, but that's the case.
And this chart just shows the inversion on a time frame since the 80s, where you can see anytime it's below that black line, typically it precedes, well, every time here it has preceded a recession. So.
Yeah.
And then just yields. This is a chart of the 2-year Treasury yield. So how much it's been paying. You can see it's skyrocketed up since September 2022. This is the fastest increase, as Alexandra's mentioned, and we've alluded to, one of the fastest increase in rate hikes ever. And you can see it in this chart where just, it's like on that really steep slope upwards, except for today and yesterday, where there was this huge pullback from almost a whole percentage, from 5 to 4.1%, which you don't see.
That's intense. That's intense. I mean, the week before we had this huge move up, you see that big spike up, and then this big drawdown today. It's the Treasury. Just so you know, this is just to show you how confused Wall Street is about direction.
Definitely.
This is just to show you how confused Wall Street is. And typically what we see, again, the yield curves, yields, stock markets are all leading indicators.
Mhm.
And you can see they're not giving us much of an indication here. Up, down, uncertain. So we have a take. We're going to do the best that we can. Do we have another slide here, Paul?
No.
No, just our thank you. Okay, so let's talk a little bit.
Yeah.
Okay. So how do we discern what's happening? What's very difficult for us, there's not enough information as to exactly why these banks did not make it, except that the Fed raised rates very quickly. We have been seeing over the past 2 to 3 months, maybe 4 months now, a lot of layoffs in Silicon Valley. And that's been a pretty intense clip. Would you say probably that's the first time I've seen layoffs in that sector since 2000?
Yeah, at that
2001,
scale, I mean,
2002.
a piece of it is mean reversion, but it looks like what these companies are telegraphing is that they do expect more to continue.
Yeah, exactly. So how we position here, this is what we can just tell you now, is as if you are a client of our company, you know we have moved to a significant cash position. You know that we've moved to mostly treasuries. We're not even really buying many corporate bonds. If we are, they've always been well capitalized companies. We have very little exposure to the market, stock market. We moved some time ago our funds into, and there's nothing sexy about this. I know we want to explain this to you, but we moved our money markets about 4 years ago into the Treasury money market. This is the safest in our mind. If you're going to be in any form of dollars, this is your safest bet, or any form of cash. Why? Because what happened 4 years ago is they passed a law that the FDIC, so on, will not back any other money markets other than money markets that are in treasuries. So if you're in any other money market, whether it's a corporate bond money market or what other ones, corporate bonds, any of the higher yielding money markets, they will not back that dollar to dollar. The only money market they back dollar to dollar is treasuries. And as far as we're concerned, as far as we're concerned, we want a dollar in, dollar out. If we're going to have cash, we're going to have dollar in, dollar out. No other way. So for those of you who are asking about cash, you have to understand, in a bank, your money is going to be loaned out. Okay. It's not going to be sitting in a treasury money market. It's loaned out. So that's why Paul and I have favored these treasury money markets, dollar in, dollar out. Now, if the whole system fails, who knows what can happen, but dollar in, dollar out. And that's what we've been doing. Now, at this point, from what we are seeing, Paul, anything to add to that?
Just that I think it was 2016 that the law was passed that changed how money markets fundamentally work in response to the 2008, 2009 time period, as a way to try to put more control. The thought process behind it was that it would make withdrawals or the whole flow of cash in uncertain times smoother. But really what it does through things like liquidity gates, where you can only redeem a certain amount at a certain time, and the ability for non-prime money market funds to break the buck, meaning that your dollar in is not your dollar out. So it changed the rules in an effort to try to make it more smooth. But I mean, I think we would argue it actually makes it more difficult for the consumer, and you can actually lose more in that type of situation.
Yeah. So, I mean, we don't and won't take any chances with money markets, period. And this is a perfect example of why that is. So we rather forego a little bit of yield for the security. That's an absolute. In terms of the banks, let's talk about the banks that they're looking at right now. There is some discussion
Let me give a little
lower
background first on so everybody's aware of what's happening at these banks, right? So as they raised so banks have all the assets that they hold, okay? And what do they do with them? They buy government bonds, or they buy certain assets to so that they're not just sitting in cash. As the interest rate goes up, the value of those longer duration assets or those bonds goes down because there's an inverse relationship. So when people go to a bank to start withdrawing their funds, normally it's not that big of a deal. But if a bank run happens, or the start of a bank run happens where many people are starting to withdraw, the bank has to start selling its assets in order to make sure it has enough liquidity on hand to meet the withdrawal demands of its depositors. But it has to sell those assets at a steep discount now. And if a bank run truly happens, or it sort of snowballs and gets bigger and bigger,
which it did,
which has happened to a couple of these banks, they actually don't have the ability to sell off their assets and make all their depositors whole, because the assets they're selling are at a huge discount from what they're valued at their maturities. And so that essentially is what has happened. The Fed has
that's one of the reasons.
Right.
Yeah.
So
yeah. But that's a great explanation, Paul, because that is one of the reasons that has happened. And how and why it happens in snowballs like that. But when one happens, then you typically see 2 and 3, and that's what you're seeing. So now there's a short list, like New York Community Bank. I think there's about half a dozen, Paul, now, or 8 that's on that short list of banks that are smaller tiered banks, by the way, known in this industry to be high risk banks, by the way. Okay. So we want to make this really clear. These are known to be high risk banks, all of them, all that the Fed is citing today. And they think, Paul, I don't know if you saw the list earlier today, all the ones they're citing are known to be high risk and high yield for a lot of people. So a lot of people were attracted to these banks, the stocks, because they were getting high yields. I'll tell you what, we always stayed away from them because I knew that their investment portfolios were going to be mired with all this. Many of the banks, the larger tiered banks, like your JP Morgans and such, they do have shorter duration portfolios. I don't know about Bank of America, but I know that they tend to have shorter duration portfolios. So what we're seeing right now is the issue is, and I'm not saying it's isolated only to, but these more risk, if you were actually to look at what we call a beta or risk indicator on these banks themselves, just in the market, they are higher risk banks for sure. So,
which would make sense that in times of stress, it's the more, riskier, whoever's further out on the risk curve is going to feel the effects of issues in the broader market first. And so that's what we're seeing right now. Now, whether that expands and, cascades into something bigger, to be determined, I suppose. I don't know if the data supports it yet, but something that we're keeping a very, very close eye on.
Yeah. So, okay. So we have some more questions. We have a few questions here. Somebody asked if T-bills are the safest now. Well, I think we can only answer this with what we know is T-bills are, if you look at anything in the markets, we would say, and this is other than globally, okay, we would say that T-bills would be, anything in the Treasury would be considered the safest investment because the government has the ultimate taxing authority. I mean, so I don't know. Should we go on to questions, Paul? I just saw that come right across my screen. Okay. So there's that. All right, let's see. So someone said that this is scary for someone close to retirement. Have you across the board placed holdings in a safe place? In general, we have gone as safe as we as safe as we possibly can, given the environment we're in. I mean, we do have some equities here. Oddly, I don't know if any of you noticed that stocks went up today and gold and cryptocurrency. So risk assets went higher. Why? Because everyone's expecting the Fed to lower interest rates. So basically, people are expecting that they're going to get the smack. They're going to get their drug of choice, which is lower interest rates. That would likely, that would likely spur this forward. I think that's dangerous. I'm not saying that lower interest rates shouldn't, the Fed should not be backstopping what's happening here, but part of the problem is like we said, we become drunken sailors. We just haven't pulled in our spending. Paul, anything you want to add to that?
Yeah, I mean, when I take a sort of step back and look at our broader portfolio, it's very conservatively positioned and in assets that very comfortable with.
Mm-hmm.
Yeah.
So then, okay. So now here's a question. I heard today that that the small bank bailout, which is happening, is for high capital investors, and the little people are being pushed to the side, which is showing a move towards small investor.
So I can
Go ahead,
speak to
Paul,
this a
answer.
bit.
Yeah.
I know that at least so this is where it can get dangerous, because one of the situations we're curious about is this now going to be a situation where the Fed is basically picking and choosing winners and losers, right? We're going to backstop this bank. We aren't going to backstop that bank. What happened with Silicon Valley Bank, arguably was for the benefit of the depositors, right? Because the Fed stepped in and said all of the depositors will be made whole, regardless of what size, investor you were in that bank. But the shareholders and bondholders are out of luck, which actually surprised me, because that seems like a departure from how they've operated in the past, where normally they would bail the organization out first. So it's I'd say too early to tell really, if this does cascade into other banks, will it be the same response for everyone? I don't know.
Yeah. I mean, in the Great Recession, essentially, the bigger banks got bigger.
Mm-hmm.
And it does disenfranchise greater groups of people in general, I would say.
Yes, one thing Alexandra and I did talk about too is how this could be another move to, well, it looks like it's shaping up to be a move to add even more consolidation in the banking sector. Less and less options. A lot of these smaller banks that, are a little more at risk might just be consumed by the larger ones.
Yeah. I mean, if you're doing business with a smaller bank, you want to know how they are, capitalized and what their portfolios look like. It's not always going to be accessible to you to know these things, unfortunately. But that's, I think, a big deal. You really want to work with a bank that has a sophisticated investment department that was ahead of this, the rates increasing. So I think that's all right. Let's see. So somebody asked a question: what happens for individuals for food and other costs during if we go into a recession? We're just in a very different time because we are looking at a lot of global turmoil, a lot of geopolitical issues that are disrupting supplies. Even though there's shipping, the cost of shipping is down, the shipments are available, we're still running into some problems around supplies. We think it has more to do with policy than anything else. The question around this is, unfortunately, we see the prices still being pushed higher. It just means you have to get conservative with the way you do things. In my opinion, the way you live, you could just do the best that you can in this environment. I don't know what to say other than, just know that prices are going higher, and at least that's been our prognosis, and we've certainly seen that.
And it definitely impacts like lower socioeconomic classes much harder than more affluent or higher. Because more of their budget needs to go towards the essentials like food and energy, transportation. So,
yeah.
Let's see.
Somebody asked about credit unions. You really have to go to your credit union and see how they're financed. In some communities, credit unions take on a little bit more risk in terms of the loans that they give, so they'll tend to allow for lower credit scores. You'd really have to see what that's all about. Paul, were we able to locate the senior loan survey?
Senior loan survey. I was not the most recent one. No.
Okay. So that's not going to do us any.
That came out was saying how they were conditions were tighter. Yeah. And they were tightening conditions. Yeah.
Okay. Yeah. Senior loan survey. It's a survey that's done by all this, not all, many of the senior loan officers at the major institutions, some of the smaller institutions. And the last update was that they were getting a little tighter with it. Now, I think we updated that a few months ago, that they were getting tighter with their standards. That would be a very curious thing for us to see at this time. Are there any more questions? Does anybody else want to ask a question here? Let's see, give a few more seconds. So what you can expect from us, I think most of the people on this call are clients, many are not, and we see, but for our clients, what you can expect from us is that we're going to continue to stay very conservative here. Again, you've been working with us, Paul and I have been seeing this, we've been moving ahead of it. That meant we missed out at the first part of the rally at the beginning of this year. We don't care. We want proof. We don't want, bottom line is, hope isn't an investment strategy. Hoping something's going to turn around before it actually does is not an investment strategy. We need concrete evidence, and we haven't received concrete evidence yet. The moment we receive concrete evidence of directionally where exactly we need to go, other than being conservative, then we'll do that. But until then, we have to stay the way we are at the moment. I think no more questions came in.
Yeah. And so if anything pops up, or, oh, wish I asked this, no, you can reach us, Alexander or myself, or info@investwithwillow.com, or feel free to give us a call. We're here. We love talking about this stuff.
We have
a lot of ideas.
I'm on the road, but I'll be back. But, obviously Paul and I are always in contact. So as you can see, we said we had to do this. So we'll probably do it. You can rest assured we'll do another update at some point this week. Just a question of when. So,
all right.
So give a ring if you need us. Okay.
All right. Well, thank you, everybody. Have a good night.
Take care. Bye.